El cambio climático es una realidad que nadie discute ya, pero medir su impacto y riesgo en los mercados es una tarea que aún está comenzando. Es una prioridad cuya discusión no podía faltar en este evento. Para nosotros es un honor presentar la conferencia magistral Measuring the Financial Risk of Climate Change. Es un gusto tener con nosotros al doctor Ron Dembo, fundador de Risk Thinking, y a Leticia Canal, fundadora y directora ejecutiva de You Are Risk. We welcome Ron and Leticia to the Risk Management and Trading Conference 2021.
Good morning to everyone. I am Leticia Canal, founding partner of Your Risk, consulting firm specialized in risk management. I personally have been an international consultant over 20 years, working in more than 15 countries. Climate recently had become a very important topic for regulators, banks, and in general for society, due to the impacts it will cause over time. The challenge for banks is to be able to identify the correct data and methodologies for measuring the financial impact of climate risk. The World Economic Forum in 2021 report has identified climate risk as one of the risks that will have more impacts worldwide. Today, I am honored to introduce Dr. Ron Dembo, one of the world's leading authorities on risk management. He's an successful entrepreneur and consultant to some of the world's largest corporations and banks. He has a distinguished academic research career as a professor of operations research and computer science at Yale University and as a visiting professor at MIT. He is the founder of riskthinking.ai, a company dedicated to the science-based measurement of climate change financial risk. He was founder and CEO of Algorithmics Incorporated, growing it organically from a startup to one of the world's largest enterprise risk management software companies. In 2005, he founded Zero Footprint, an innovative technology company focused on climate change. In 2007, Ron was a lifetime fellow of the Fields Institute for Research in Mathematical Science for his contribution to Canadian mathematics. He was also awarded as a Distinguished Alumni Medal from the University of Waterloo for his exemplary leadership in risk management and environmental protection. Good morning, Ron. It's a pleasure having you today.
Hola, muy buenos días, México. Hace unos 20 años estuve no lejos de aquí en mi despacho de Algorithmics, presentando una plática a una conferencia de bancarios en Puebla. Y sin Zoom. Ahora, quiero agradecer a la gente de Riskmatics por esta generosa invitación de dar este keynote hoy sobre el asunto que yo creo es el más importante de hoy. Good morning. It's a pleasure to be joining this audience and to discuss the important topic of climate change. It's a huge topic, and in the half an hour to 35 minutes I have, I think we'll try our best to cover most of it. So it starts with the notion that today, climate risk is not priced adequately into the market. It's pretty clear. Imagine a market today where credit risk wasn't priced. It would be quite an asymmetric market. And that's what we believe is the case today. The true risks of climate change will affect economics and economies of countries quite radically. So just to give you an idea of how I organized the presentation, I'd start with market pressures. What's really driving the changes that you're seeing today? Then I'll talk a bit about data. And if you were to go around, as McKinsey did very recently, to all the banks in the world, the major banks, and ask, what's your major problem with climate change? You would hear data, data, data. So why? And I'll go through that. And then I'll talk about the various types of risks that you encounter in climate change and the differences with some risk management in a purely financial world. I'll then touch on standards, because this is a world where standards don't exist today, and you need them. And finally, I'll talk about a solution and how we might rate climate. So let's start with market pressures. Rating agencies started applying pressure quite a few years ago, and we can actually see the effects of this. ExxonMobil stock has actually not done very well, and so the same is true for many oil companies. There's a lot of investor pressure on oil companies as well. But there's also the impending regulations. This has been going on also for a few years, but they already are starting to take effect. Bank of England has a stress test on climate. The Bank of France, Banque de France, has been doing this for years. And the director of IMF is really pushing for climate. So there's also pressure from sovereign funds who control huge amounts of money, as well as large asset managers. For example, Norway's pension fund pulled out of Alberta oil sands. And the reason is, these production of oil from the tar sands produces a huge amount of carbon in the atmosphere. So any company that is carbon intensive is coming under extreme pressure. And they're actually now being regulated. Large companies are being regulated to produce their climate risk. So how do they do that? I mean, what do you do and how? So first of all, climate-related data is very fractured. It's housed in many sites. It's even in satellites. It's in many languages. It's of inconsistent quality. They're mixed different models and measures, and it's not readily available, and there are no standards. Also, climate scenarios that are presented today are ad hoc and inconsistent. I'll teach you a nice little word in English. We call that BOGSAT, B-O-G-S-A-T, which is another way of saying boys and girls sitting around a table guessing the future. So how do we overcome this? How do we get to scenario generation that allows you to compare across markets? You can't scale 6 people sitting around a table and predicting the future or dreaming about the future. So current comparisons are really apples to oranges. Climate science is actually complex, and one of the most important things is it's just riddled with uncertainty. The science itself is uncertain. Let me give you an example of a bit of climate science. The Indian Ocean dipole is the difference between the temperatures of the East and West Indian Ocean. Now, in the East, when it's cooler, there's less moisture in the air, and that affects Australia. When it's warmer, as it is in a positive phase, you have the east coast of Africa getting much more rain. That causes floods, mudslides, and a lot of social upheaval. So one climate modulator affecting multiple parts of the world simultaneously. And this is a key to climate change. So a few years ago, we saw in Australia, these floods in East Africa and Australia burning. And that caused, millions of people to be disrupted, a lot of deaths and a lot of food problems. And in Australia, simultaneously, we had a lot of biodiversity loss, a lot of economic loss, and people actually passing. So one thing you have in climate is causality, but what you don't have is probabilities and correlations, the usual tools that we use for measuring financial risk. I mean, just imagine if I gave you 2 variables and I said they correlated in 2050 and the correlation is 0.254. would you believe me? I mean, how can one correlate that? So what you do have to rely on is causality. So here's an example of climate causality. A climate modulator, like an El Nino or an Indian Ocean dipole, affects regions all over the world. There are 33 regions that are, actually 64 now, that are homogeneous and defined by the UN. In those regions, you have different risks, and there are two types of risks. There's chronic risks, like sea level rise. They happen slowly and imperceptibly, and carbon emissions, and acute risks like drought, wildfire, heat stress. And both of those actually need to be measured. So they lead to what are called the risk indicator, risk factors. Things like the daily freeze and thaw cycles if you were in Canada, annual mean temperature, or the number of heat waves if you were in Mexico. So we looked around when we started risk thinking for standards, and we could not find any. I mean, so we developed our own, and we've called it the Climate Risk Classification Standard. And that's the key that has enabled us to actually measure and organize data on climate. So this is just a little example of this. But imagine if I were to not have standards like this. Think of the GIC standard in equities in the US. That tells you what a transportation sector is, for example, in the S&P. And if I said transportation sector, you'd know exactly what I mean. But that didn't exist for climate. And so here it is. So that enables us to take the world, divide it up into little hexagons that could go down as low in area as a half a square meter, or as large as 150 square meters is what I'm showing now. And what we do is we can actually align all of the data that's needed in all of these locations in a completely consistent way, which is not done today. So this is the challenge. People have not been able to do this because they've not had the standards. So what's different between climate change and normal financial risk management? Well, for one thing, you can see climate change is very geographically based. But there's one other thing, is that these geographies, these hexagons, are actually correlated. So when you have an El Nino or an Indian Ocean dipole, what's happening in one hexagon in East Africa is correlated with what's happening in Australia. So one of the things that this came out actually today, this article, is that people are really worried about the number of hot days that might occur, or the number of days that have both heat and high humidity. And that could actually be more of a killer than COVID. So let's take a look at Mexico. Here's Mexico in 2030. Now, if you were to look at it on the scale below, it's a little hard to see, but you'll see that certain areas are a little darker. And when you see darkness, you're seeing an increase in the number of heat wave days. So we're seeing that central Mexico is actually a little hotter than it was in the last 20 years, or averaged over the last 20 years. And if you look at Cancun, as we pass through time here, you're going to see Cancun looks the same. That means that it's not getting much hotter, it's getting a little hotter. But what's really happening is central Mexico is really getting very hot. And if we look at it in 2090, according to a number of different models, we can look at this under different scenarios, different models. We see this a scenario where, Mexico City will have 140 more hot days a year than it has today. And it's not equipped for that. Mexico City is not equipped for Cancun weather, or weather that's hotter than Cancun. So where do we find data to represent the uncertainty in science? Because that's the key. We need to capture that uncertainty. So one example of this might be a trusted source like Nature Communications. Another might be, a different journal. But there are many hundreds of thousands of these articles, and these are essentially climatologists, climate science people making predictions about the world based on models. So that's interesting. In order to capture that, and that's the only source that we have truly for forward-looking data, but in order to capture that, we need to read something like 250,000 articles to get up-to-date information. So we've developed a whole suite of machine learning tools, some of which are quite unique and brand new, to be able to extract from those articles the uncertainty in the future, according to science. And that uncertainty is really represented as distributions. So in every hexagon on that Earth's surface, we also are calculating the distributions of the risk factors, which are both economic and climate. For example, if we were looking at Singapore in 2050 and we were worrying about sea level rise, we would see that as a distribution, not a forecast. There's also expert elicitation, which is a fancy way of saying scientific-based polling, where we capture what's in people's heads and the sentiment about the future. So what are the risks? Well, it starts with stranded assets. A stranded asset is something like what's probably going to happen to a lot of oil companies. Oil companies are measured and valued on the amount of oil that they have license to that's still in the ground. And if that oil becomes too costly in terms of its carbon content and in terms of its production, then, no one's going to dig it out, and that's a stranded asset. So Canada, for example, has something like $300 billion of potential stranded assets. That's the tar sands, which might never, ever be exploited. But let's look at Mexico. A few years ago, there was a series of articles on Mexico that said, to quote, "The study states that Mexico has the highest potential of all the countries in the world to experience stranded assets within the power sector, and that possibly 50% of all Mexican economic infrastructure is set to be abandoned by 2050. It's pretty dramatic. But it doesn't take much of a climate event to cause huge damage. One, Maria was the hurricane that hit, really destroyed the island, essentially, caused $140 billion of losses. One spark in California actually set one of the biggest utilities in the world to bankruptcy. I was in California giving a talk about this exact subject in November 2018, in actually October, late October. I actually used PG&E as an example, and only a short time after that, PG&E went from 25 billion in value to 3 billion and bankruptcy. Why? Because a fire was lit by one of their transformers in a dry forest, which burned down part of the city and killed a number of people, and the lawsuits. So what you see there is the environment causing a social problem, which then causes governance problems like lawsuits. Californian economy, you're seeing might and where blackouts would have to be installed. The only way today California can manage fires like this or manage this risk is by switching off electricity. So imagine California, with an economy bigger than Canada, has to switch off electricity for days to be able to mitigate climate risk. That's a very expensive way of hedging. But just very recently, we saw the freeze in Texas. And you might say, what's the freeze got to do with climate change or global warming? Well, when you have global warming, the jet stream tends to wobble. And when it wobbles too much, you get very cold air dropping down into Mexico even, and snow happening where snow never happens. And that can freeze up so the one thing that happened in Texas, which is Texas is completely cut off from the rest of the United States in terms of its electricity. So it has no way of hedging electricity when it runs out. And this cost also something like $1 billion in damage, but also a huge governance risk, tons and tons of lawsuits, and a huge social risk because people were suddenly having to pay 10,000 times the normal price in this extreme situation for electricity. Well, in other parts of the world, you get things like food risk. 85% of all food generated in the world comes from subsistence farmers that are not insured and not capable of dealing with this. So climate change poses a huge food risk. One of the most interesting pictures I've ever worked with, this was part of my talk in California, was overlaying a scenario where it could occur with the scenario, with the picture of the map of California, which shows all of the electricity infrastructure. So the little blue dots are electricity infrastructure. And if these two, you'd see that wherever there's fire, there's going to be infrastructure. So California's got a huge problem on its hands. So what you saw there was the interesting part of ESG. You're going to hear a lot about ESG, but ESG is a real mixed bag today. ESG is often just how much diversity do you have on your board? Do you employ slaves? Are you better your employees and so on? But what's really interesting is the mathematical side, which is how do environmental risks and costs have an implication on social risks and costs and governance risks? So that is what we are doing here and what you actually saw. There are many types of risks, and I'll talk about a few of them. We've talked about some already, which are social and governance, but let's talk about transition, physical, and investment risks. So a transition risk is really a description of the future, according to experts. So it's a bunch of experts sitting around a table and they predict, and in fact, the group of central banks, the NGFS, just put out 72 transition scenarios, which are, to give you an idea, each scenario has 1,700 plus economic variables, one climate variable, temperature in the world, and describes from today all the way to 2100. So given a particular transition, what we do is generate stress scenarios on physical infrastructure. So given a transition might be a move to net zero or the climate being a 2-degree climate. So given a transition, you can calculate physical risk. And that's the impacts that we saw. I'll give you an example of this. And given the same transition, you can also calculate the impacts on an investment portfolio. So this is one way in which you create consistency. But today, as of today, in banks around the world, including some of the biggest, this is not done. And there's no consistency between the way physical risk is measured and investment risk is measured. We believe consistency is absolutely essential. I mean, there's no other way you can compare an apple to, there's no way you can compare an apple to an orange. Transition risk itself is very interesting and a big struggle for banks today. The transition risk is really because transitions themselves are uncertain. I mean, how can one be certain about how the economy of the world will evolve over the next 50 to 100 years? So I'm going to talk about the first two, but not the third, just because of the complexity of it. So the workflow for calculating physical risk looks something like this. Given a transition scenario, it says carbon's going to do this and that, and the GDP in the world will do this and that, and so on. We plug it into our standard, our climate risk classification standard, and align all of the data in that transition across all of those hexagons in the world to be able to get the risks at every point on the Earth's surface, including the sea. We then generate, using the uncertainty in the future factors, we use an algorithm that I developed and is patented actually to generate macro multi-factor stress scenarios. Now, why multi-factor? Because we saw that for example, in California, a fire is really the combination of three factors: heat, drought, and high winds. So you need scenarios on multiple factors, and that's been elusive to the banking world. It's very hard to generate those scenarios. Humans can't do them very well. So the question is, how do you do that? Once you have them, you evaluate the impact on the asset. It could be a building, it could be a loan or a collateral for a loan. And ultimately, you get a distribution of potential gains and losses under different scenarios. Investment risk is similar. You select a group of portfolios and you say, there's certain key macro factors that affect. So given a transition scenario and those macro factors, we align all the data in the world again, and we generate multi-factor stress scenarios. From that, we can actually develop microeconomic factor shocks and develop the impact on portfolios. But once again, at the end of the day, you get a distribution. So each bar in that distribution is the gain or the loss in the portfolio. Now, here's a problem. How do you rate climate risk? I mean, we rate everything. We rate credit, we rate loans, we rate investment portfolios. So imagine if we could find a single and meaningful, consistent rating mechanism that measured the impact of climate change uniformly on each and every business unit, say in a bank. Well, just as CCAR helped banks manage their business better, so this will lead to climate risks. Better capital reallocation, different liquidity policies, and so on. What CCAR did, which is a single stress scenario, it really forced banks to organize their data across the bank. So, way to do this is what we call the climate risk adjusted return, which in this case is either normalized upside over downside. So look at the upside, which is the green part of this distribution, and divided by the downside, the orange part, we get a CAR value. If we normalize it, a CAR less than 0 means that climate change is more likely to affect your portfolio negatively than positively. So we can apply this to a bank, for example. So here's a bank which has branches in Canada and the US. And let's say it just has personal and business banking, capital markets, wealth management. We can rank these businesses as to their exposure to climate using CAR. And a red in there means that the personal business banking, for example, in Canada is more exposed to climate change than to a downside because of climate than an upside. And a different situation in the US where the personal and business banking is actually positively exposed to climate change. In other words, they will make money because of climate change. So climate change can affect people both positively and negatively. And this is the same is true for an impact on funds. I distributed 2 papers to the audience. One which was how we calculate climate physical risk and climate investment risk, which is what we've just talked about. And that'll give you more detail. So our solution is to first organize the data. Today, we have something like over 2 petabytes of data that cover the entire world surface, and it's growing. We have relationships with Planet.com. It's a satellite company, and pretty soon, that will double and treble and so on. So here's an example of physical risk. This is a bank in the US. It's one of the largest banks. You would recognize its name. And this is their private equity portfolio of buildings, and this is where they're located. It's hard to see, but the little white dots in there, those are the actual buildings, and the hexagons are shown here. But we can immediately say by putting those latitude and longitudes of those buildings in, we can immediately say a lot of things about them. So for example, if we look vertically here, in the best situation, the best scenario possible that we could find, there's 5% of those buildings that will be affected by heat stress by 2030, and that grows to 25%. So what does this tell you? It says we should focus on this 5% to actually either retrofit them or sell them. Otherwise, we might be exposed to either reputation risk if some people die in those buildings, as happened in France. There was an extreme risk. The Central Europe cities are just not built for heat, and they're going to experience huge heat situations. But we can also look at it crossways, and this is the best case under all of our scenarios and the worst case in 2030, and we can see there's a huge difference. And if we were to look at the worst case over time, we could see that 63% of these buildings would be subject to heat stress. So this tells you where, when, how to hedge, and where to hedge, and what the bang for the buck is, the cost versus the benefit. And we get that from a stress test, the output that you're seeing from our app. So let's go into some theory here, just because I'm sure there are quants in the audience who would love to see some math. So let's talk about that, how we actually model this. So firstly, the most important thing about dealing with radical risk in the future is understanding the uncertainty in that future. Radical risk is risk where there's not very good data at present or historical to inform the future. And all of this data is actually sitting in people's heads in the sentiment about the future. So we get those distributions either with machine learning or structured judgment. And they look something like this. This is actually taken from the talk I gave in California. And the factors that they were looking at, you can see, are a mixture of economic and non-economic. They include temperature rise. What's the temperature going to be like in California in 2050? Well, there's a big distribution for possible values. What's renewable growth going to look like? That's the green distribution. Regionalization is how will the states of the West collaborate on sharing electricity? Well, that's a political issue, and low growth is really, an economic one. What we really would like to have is the distribution of the combinations of those factors in order to understand risks. Well, how do you get that? One way to get it is to say, let's take a binary view of this. Let's look at extremes, because managing the business and in a non-extreme situation, anyone can do. But managing the extreme risks, as we've seen in California, is hard. So we lump everything in the tails, and we get a binomial tree where we actually generate the distribution on the combinations of factors, which are paths in that tree. Well, here's a nice little result where we can actually say something about the scenarios we're generating. Let's define a spanning set of scenarios to be one that contains with certainty the worst case and the best case a priori. In other words, this looks almost impossible to do because you don't know whether a scenario is good or bad until you apply it. Well, we can say with certainty, regardless of what we're looking at, that the set of scenarios that we generate will contain the best and the worst. We don't know which ones they are, but we know it'll contain them. And there's a nice little result that's actually quite a almost obvious result, is that conditions in the risk factors, and I'll describe them in a second, the algorithm will generate a spanning set. So we have a way to take the uncertainty in climate science and with it generate multi-factor distributions which allow us to stress test portfolios. This is quite unique. I'm not sure, I haven't seen another way in which you can algorithmically generate scenarios, but one of the great things it does, first of all, is we get a really good result. We know something about the scenarios we're going to generate. And secondly, we have a consistency in the way we might generate scenarios across markets, within markets, and so on. So that's a bit of a mouthful. I hope some of it really inspired you to really look at this area much more closely, because you're going to be looking at it regardless, I'm pretty sure. Thank you very much.